ESG isn't a buzzword anymore, it's the price of your money.
For years, companies treated ESG like a reputation exercise, a checkbox for annual reports. But that era is over. Today, banks and investors price ESG into every loan, every bond, and every valuation model. So the real question isn't should we do ESG anymore. It's which ESG KPIs actually lower our cost of capital. Because only the financially material metrics, the ones tied to risk, resilience, and performance, move your margins and spreads. ESG isn't a story you tell. It's a pricing lever you pull when you know which KPIs matter.
Reputation builds trust, but KPI builds credit.
WACC equals weighted average cost of capital equals KD times debt percent plus CO times equity percent. ESG affects both. Better environmental and governance scores, lower default risk, narrower credit spread, lower KD. Stable social and governance practices, lower beta, lower CO.
Every basis saved is earned through discipline.
ESG used to be a reporting exercise. Today, only financially material KPIs move your pricing. GHG intensity cuts loan margins. Board diversity lifts valuation multiples. LTIFR lowers insurance premiums. Energy intensity unlocks green bond discounts. Supplier compliance reduces cash flow volatility. And the payoff is real, cutting CO2 per revenue from 0.45 to 0.30 ton per MUSD or 0.25% off your interest cost, over $1.2 million saved. ESG isn't about tracking everything, and actually lower your cost of capital.
KPIs don't just tick boxes, they buy down rates.
Most companies talk about ESG, but few understand how it directly cuts their cost of capital. The math is simple. WACC ESG equals WACC base minus delta ESG score times beta ESG. If your beta is 2.5 BPS and your ESG score improves by 10 points, your WACC drops 0.25%. That's $500,000 saved every year on a $200 million debt base. That's the power of financially material ESG, not storytelling, but real pricing impact.
When numbers meet purpose, finance starts to change.
A regional energy firm proved ESG isn't theory, it's pricing power. They linked their loan rates to two KPIs, carbon intensity and female leadership. The results were dramatic. CO2 down 28%, female leaders up 12%, and their loan margin dropped 0.3%, saving $3.6 million every year. Visually, picture a bar chart where WACC slides from 4.8% to 4.5%, while their ESG score climbs from 70 to 84. That's the story. When ESG metrics are financially material, they don't just look good, they pay off.
ESG isn't a cost center, it's a profit lever.
Governance is the multiplier of ESG trust. It's the anchor that makes every environmental and social claim believable. Because without independent oversight, transparent controls, and real policy enforcement, even the strongest E and S scores start to lose credibility. Investors know this. Lenders know this. Markets reward companies where governance isn't a checkbox, but a system that actually works. Strong G doesn't just support ESG, it amplifies it, turning good intentions into trusted performance.
Governance turns good intentions into financial results.
CFOs are redefining ESG from a reporting task into a financial engine. The playbook is simple. Start by integrating ESG KPIs directly into your finance dashboards so every decision reflects real performance. Use those results in loan negotiations because stronger ESG metrics now translate into better pricing. Embed ESG clauses into your debt contracts to lock in incentives and protect downside risk. And in every quarterly review, report the ESG to cash impact so the organization sees the financial return, not just the narrative. This is how CFOs turn ESG into a measurable driver of cost of capital.
ESG belongs in finance, not just in CSR.
The relationship between ESG and cost of capital isn't linear. It follows a credibility curve. Picture a cyan line dropping from 5.2% WACC at an ESG score of 60 to 4.8% at 80. That's where most of the pricing benefit happens. But after a score of 85, the curve flattens. The market stops rewarding additional ESG claims unless the underlying data is verified, consistent, and audit-ready. For mature ESG firms, the next reduction in WACC doesn't come from higher scores. It comes from stronger data credibility.
At the top of the curve, transparency becomes your currency.
Reducing financial costs through ESG has nothing to do with thick reports or glossy disclosures. It comes from KPIs that are relevant, verifiable, and bold enough to influence real pricing. CFOs who get this don't just shave a few basis points off their interest expense. They build trust with lenders, strengthen credibility with investors, and unlock a valuation premium that reporting alone can't buy. ESG isn't paperwork. It's a financial instrument. When you measure what truly matters.
If this showed you how ESG becomes financial power, subscribe and join me, Thanya, to turn data into capital.